For more than 70 years, the US dollar has been the backbone of the global financial system. It's the currency used to price oil, settle international trade, issue debt, and store national reserves. Even countries that don't always see eye to eye with US policies still rely on the dollar to function in the global economy. On the surface, it looks like nothing has changed. The dollar is still dominant. It still accounts for the majority of global transactions, and it still sits right at the center of international finance. But if you look just beneath the surface, a slow and deliberate shift is underway. Countries aren't rejecting the dollar openly. There are no dramatic speeches or official declarations. Instead, governments and central banks are making quiet, technical adjustments, the kind that don't grab headlines but reshape entire systems over time. This isn't a revolution, it's a recalibration. And it's happening for one simple reason. Dependence has become a risk. The modern dollar system offers stability, liquidity, and efficiency, but it also concentrates power. Access to dollar clearing systems, correspondent banks, and financial infrastructure ultimately runs through institutions subject to US jurisdiction. Over the last 2 decades, countries have seen how quickly that access can be restricted through sanctions, asset freezes, or regulatory pressure. Even close allies have learned that the dollar system is not politically neutral. This realization didn't just arrive overnight. It accumulated slowly through a series of crises. During global financial shocks, dollar shortages often hit hardest outside the United States. When US interest rates rise, capital flows back toward American assets, weakening other currencies. For emerging economies, this can trigger inflation, debt stress, and major economic crises even if their own domestic fundamentals are perfectly sound. Over time, governments started asking a very uncomfortable question. Why should our economic stability depend entirely on decisions made in Washington? The response to this question hasn't been confrontation, it's been preparation. One of the clearest signs of this shift can be seen in central bank reserves. While the dollar is still the largest reserve currency, its share has been slowly but surely declining over the past 2 decades. Now, it's important to understand this decline hasn't come from a mass. Central banks know that dumping dollars would damage their own portfolios and destabilize global markets. Instead, they've chosen a different path: diversification. Gold has played a major role in this strategy. Central bank gold purchases have recently reached their highest levels in decades. Gold carries no political risk, no counterparty risk, and no sanction exposure. It's not being used to replace the dollar in everyday transactions, but it does reduce reliance on it as a long-term store of value. Alongside gold, reserves held in euros, yuan, and smaller regional currencies have also increased modestly. Each adjustment is small on its own, but together, they are beginning to change the balance. Trade settlement tells a very similar story. Increasingly, countries are exploring ways to settle trade between themselves without routing payments through the dollar. We're seeing more energy deals settled in local currencies, more swap agreements between central banks, and the rise of regional clearing systems. These arrangements rarely attract much attention because they're technical and often limited in scope. But their purpose is crystal clear: to reduce friction and vulnerability. This trend is especially visible in regions with dense trade networks. Think about it: when 2 countries trade heavily with each other, using a third country's currency introduces unnecessary risk and costs. Settling trade in their own local currencies reduces exchange rate risk, lowers transaction costs, and minimizes their dependence on external systems. Again, this isn't about replacing the dollar. Globally, it's about avoiding unnecessary reliance in situations where practical alternatives exist. Debt markets reveal another quiet adjustment. Many governments and corporations still have vivid memories of what happened during past dollar-driven crises. Borrowing in dollars can be cheap when times are good, but it can be devastating when the dollar strengthens and refinancing costs suddenly explode. As a result, many countries are now working hard to develop their own local currency, bond markets, and encourage domestic financing. This makes them less vulnerable to external shocks and gives their policymakers more control during economic downturns. Technology has become a huge accelerator in this process. Modern payment systems now allow for faster, cheaper cross-border transactions without having to rely entirely on the traditional correspondent banking networks. Regional platforms, real-time settlement systems, and new digital infrastructure are making it easier to transact outside the dollar for certain types of trade. These systems don't threaten the dollar's global role, but they do make alternatives much more viable at the margins. At the same time, the global economy itself has changed. Trade is much more regional than it once was. Supply chains are being restructured, with a new focus on resilience rather than just pure efficiency. This naturally reduces the need for a single, universal intermediary currency in every single transaction. This fragmentation doesn't eliminate the dollar's importance, but it does dilute its exclusivity. Ironically, the United States remains the biggest beneficiary of the current system. Dollar dominance allows the US to borrow cheaply, run large deficits, and absorb global capital during periods of uncertainty. None of the countries that are quietly diversifying away from the dollar actually want to destabilize it. A disorderly decline would hurt everyone. And that is precisely why this shift is happening so silently. Even the governments most publicly associated with de-dollarization continue to hold large dollar reserves, issue dollar-denominated debt, and trade heavily in dollars. Publicly challenging the system would only invite volatility and potential retaliation. Quiet adjustment achieves the same strategic goal without triggering a conflict. Of course, domestic US factors also matter. Rising debt levels, persistent fiscal deficits, and political uncertainty around budgeting and governance all introduce long-term questions. While global investors still have immense trust in US institutions, central banks have to think decades ahead. For them, diversification isn't a rejection of confidence, it's just smart insurance. History shows us that dominant currencies don't just collapse suddenly. The British pound didn't disappear overnight when the dollar rose to prominence. It gradually lost its central role as economic power shifted and alternatives became useful. Not necessarily superior, just useful. The same pattern appears to be happening today. No single currency currently offers the scale, liquidity, and trust required to fully replace the dollar, but many now offer enough functionality to reduce dependence on it. What we are witnessing is not the end of dollar dominance. It's the end of dollar exclusivity. The global financial system is slowly evolving from a structure built on a single pillar into one with multiple pillars. The dollar remains the central pillar, but it is no longer the only support holding everything up. This transition is happening quietly, because any noise would be counterproductive. Stability requires discretion. The most important shifts in global finance rarely come with big headlines. They happen through subtle changes in reserve allocations, trade contracts, payment infrastructure, and risk models. By the time these changes become visible to the general public, they are already deeply embedded in the system. Countries aren't announcing a move away from the dollar because they don't need to. They aren't trying to overthrow the system, they're just trying to survive within it more safely. And in a world where financial power equals strategic power, silence isn't weakness. It's strategy. Thanks for watching. If you found this interesting, make sure to like and subscribe for more deep dives into the forces shaping our world. See you next time.